Welcome to Growth and Inspire, where we examine topics that may make us feel inspired and grow. Do you want us to stop and do it again? Welcome to Growth and Inspire, where we examine topics that make us feel inspired and grow. I'm your host, Bonnie Yam. Today, we will be covering the importance of retirement planning with a special reference to long-term care. This is all about planning for the future. We hope to help you navigate the complexities of aging, caregiving, and ensuring a safe, secure future for yourself and your loved ones. Our speaker today is Claude Thau, 30 years in long-term care, former actuary. He had worked for the government on the long-term care program for the employees and has been named one of the top 10 power people in this industry. Hello, Claude. So happy to have you on our podcast. Before we start, can you tell us a little bit about yourself?
Okay, well, you already said a lot about me. So, I'm a former inner city school teacher, and I consider myself to be a teacher more than a businessman or an actuary. So hopefully that'll come across. And I've been, pretty knowledgeable in this because I do the most read surveys in the industry. You go in-depth analysis and, surveys that are 20, 20 pages long every year for the last 20 years. I used to run a major long-term care insurance company's long-term care insurance business, so I know pretty much know the insides and the outs about it.
Wonderful, because I know this is a very, very complex topic. So, okay, so to start, can you tell us a little bit about the planning elements? When we think about long-term care, what are the things that we should think about? What are the elements?
So I'm really glad you asked that question because a lot of people in our industry say, "Oh, you need a long-term care plan. You should buy insurance." Well, that's how some people do it, but it's really more effective if we can understand what your plan is for if you need long-term care. If you were to need long-term care, where geographically would you be likely to get it? Consider that your spouse may no longer be alive. In that case, where would you get it? You might move to where your children are living, etc. Who is going to be able to provide some care for you and such like that. The
Yep.
more that you can develop a plan like that, the more effectively we can fit an insurance product that will be helpful for you.
Yep.
So, what kind of venue would you like to be in? Would you like to be at home, no matter what it
Of course.
costs to stay at
Yes.
home?
Yes.
Or would you say, if I can't get out, I'd rather be in a community where I meet other people, like an assisted living facility or nursing home. So, we having that discussion, like I say, helps us to tailor a plan to be most efficient for you.
Mhm. And then obviously, depending on your choices, the cost of care is probably a little different too. Can be pretty extreme, in some cases, right? So, when people buy long-term
Yeah,
care,
the
what are the
cost of
options?
care.
Hmm? Sorry.
Okay, so let me get back to the cost of care, which you were mentioning. You'll see a lot of studies that show how the cost of care varies by state, but it's really not by state. The cost of assisted living facility or nursing home varies based on the cost of ground because these are built on properties, right? So
It's expensive.
where
Yeah.
where property is more expensive, such as the urban area and the suburban area, it's and particularly pockets like the dense East Coast where property values are so high, or California where property values are so high, that drives up the cost of facility care a lot.
Of course.
Ironically, the cost of home care is more expensive in rural areas because it's harder for people to get out there to provide the care. So they'll usually have a minimum number of hours that they will charge in order to be able to cover the time of going out there. So care is a little less expensive in the urban areas, and facility care is a lot less expensive in the rural areas. But facility care can range a lot, and a lot depends on, do you want to be at the Ritz or the Motel
Ha ha
6, so
ha.
to
Of course,
speak,
I want
right?
to be the Ritz.
The average cost of a nursing home, exactly, right? People do want to be at a nicer care, so you have to be careful using, the average cost is $10,000 for a nursing home, $10,000 a month. It's the median in our country, but
10,000.
some people want to plan for more. I don't encourage them to insure enough to cover a nursing home. I think that would cause them to be overinsured. I
Yeah,
suggest that they aim for the cost of perhaps, and it's going to vary from person to person depending on their other assets, their income, and such. But I suggest that they aim for the cost of an assisted living facility, which is, maybe $5,500 a year. And then if they need a nursing home, they can supplement their insurance with their cash flow and assets because when you go into a nursing home, there's a really good chance that you're the survivor of your marriage or your relationship. Because if you still have a relationship, you're going to do whatever you can to stay at home. So when you go into a facility,
you don't
you're oftentimes
class one.
you were single, if you will, at that point. So
Right? Makes sense.
once you
Yeah.
go into a nursing home, you can sell your house, you can sell your
Doesn't
car.
matter
You
anymore,
no
right?
longer have to pay for car insurance or car maintenance or home insurance or home maintenance. The facility's paying for your room and board,
Hmm.
except for maybe some snacks. They're paying for your utilities, except maybe your phone, your travel budget, your entertainment budget, your clothing budget, all
Hmm. Hmm.
decrease a lot. So generally, you have your income that you're getting at that time is not encumbered by other things, so you can use that income to supplement your
Makes
insurance,
sense.
and
Makes
therefore
sense.
you don't need as much insurance. Another aspect is you specialize and service a lot of people in their 401ks,
Hmm.
and that's wonderful. It's so critical for people to maximize their contributions to their 401k, maximize their employer's match. And one of the benefits of that is that the more income you have from your 401k in your retirement years, that also allows you to perhaps buy less long-term care insurance. So you can maybe save a little
Self-fund,
bit money on
basically.
long-term care
Yeah, I
insurance
got the money. I
and,
pay for
and use
myself.
extra return on it's like a little extra return on your 401k. Yeah.
Yeah, so there's flexibility. If I got money, I can decide. I can self-fund some part of it. But if I, like some part, also people will probably tell you it's such a pain at the end of your life to pull cash out from portfolios or whatever that's not no longer being managed by you, probably by your kids and all that stuff. And there's a lot of complications, family complications. So if you have a long-term care insurance that pays you $5,000,
Mhm.
$6,000 every single month, I think there's like a lot less quarreling. Whose money, what portfolio should you be getting the money out? And if it's more than one person, and the family is structured nowadays are very complex. It could be, more than one marriages. So
Yes, it's complex and it's expensive. You if you pull money out of your 401k when the 401k is down,
aha, at the wrong
that can be
moment.
costly.
Yes.
If you
Mhm.
pull it out when the 401k is high, you can get a lot of tax. You can get a big tax
Taxes.
bill. All right, and 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 you also have, you can have conflict in the family because one child is, yeah, spend all of my inheritance on your care. That's important. But
Right.
another child might be thinking that inheritance is what is going to pay for my kid's college education. So having an outside insurance
I
policy
think so
that
too.
can cover the care,
Less
can be
conflict.
very, very comforting. It's a
Yeah.
lot of psychological
Yes,
reasons.
I think so. Particularly when you say, don't even cover the max, just cover the assisted living care. Okay, so whatever additional, then you pull from the 401k
Mhm.
or whatever
Mhm.
to cover the difference. So at least like the basic, number
Right.
every single month, I know it can go up from this long-term care insurance company. Yeah, yeah. So like how much should somebody budget for, or what's a good age to buy long-term care insurance?
So how much you budget? it's really up to you. The cost of the insurance depends so much on the parameters that we were just talking about. How
Mhm.
much coverage do you want in various respects and at what age? So the best age to buy long-term care insurance is is today, whatever age you are
As soon
today,
as possible.
if and only if you're comfortable that you can afford the coverage and will be able to continue to afford the coverage. And the reason why now is the best time to buy, uh, first of all, uh, think of like a bank account, right? Everybody's comfortable and familiar with the concept of opening a bank account for your child or your grandchild when they're born, because if you put the money in, compound interest will make it grow tremendously by the time the child, comes of age and needs the money. It's the same thing with long-term care insurance because we put escalators, compound benefit increases on these policies so that because the cost of care is going to go up. So
Exactly.
we want your insurance amounts to go up. So
Hmm.
we'll typically put a 3% annual escalator on your insurance. The premium
Hmm.
is intended to stay level, but the benefits are planned to maximum benefit to go up 3% every year. And because of that, you want to buy it as soon as possible because you want to get that escalation
To
started.
catch up
If
to.
you buy long-term care insurance, let me see if I can pull something up here. Thought I had it open. Um, if you buy long-term care insurance, I won't get into the specifics, but a fairly common policy. If you buy it 40 years before you need care, it would give you more than $935,000 of potential benefits by the time you need care. If you wait 10 years and end up buying it 30 years before you need care, it would provide 696,000. So by
Mhm.
waiting 10 years, you have forfeited $240,000 of coverage
Mhm.
by not having that compounding started. And if it's a couple, if it's you and your spouse, you can imagine between the two of you, that's almost $500,000.
Mhm.
So the second thing, of course, is the premium is intended to stay level, but the premium is based on the age that you start. So if you buy at age 45, the design I was contemplating when I was mentioning the $935,000 would cost a couple. There would be $935,000 of coverage for each of them in 40 years. That would cost you $4,100 together. But if you buy it 10 years later, it would cost you, assuming the prices are the same as today, and assuming your health is good, $5,100 a year. So it would cost you $1,000 more every year, about 20% more every year. And as I mentioned, you'd be getting, $240,000, about, 25
Yeah.
more than $25,000 less coverage. So if you wait, you pay more every year to get less. And of course, the risk is that something could happen to your health and
Before.
possibly you
Yes.
might need care and not be covered. That's not very likely. Not a lot of people need care at young ages, but it can happen.
Right.
More likely is something happens to your health and you can no longer qualify for the insurance. You have to, people say you pay for it with your money, but you buy it with your health. And so the longer you wait,
Mhm.
the more likely you are to be declined for the coverage, or you could be asked to pay, 10, 50, 25, 50% more each year
Mhm.
because of things that happen to us as we
Yes.
age. Our
Yes.
our build changes, right? Our
Yep.
height weight changes. We get adult onset diabetes. We have surgeries and things like that.
Yes,
So
the
you
health
want
is
to
no
you
longer the
want to the healthier you are when you buy it. Most people will never be healthier than they are today. So it's a good
because
time
we as we age.
to buy.
This is also, the other reason people don't buy is because they said, maybe I don't even need it. I just, boom, I'm gone. So I might not be able to use all the coverage that I bought, and they start hesitating. So they push it back and they push it back. So what do you have to comment on that? So should I still do it or should I not?
Yeah, so there's several issues around that. One is, a lot of people like to think that they'll never need it,
Mhm.
but most people will need at least some long-term care. Uh, and if you think about what killed your parents, oftentimes what killed your parents are things that no longer kill people, right? People survive cancer, they survive heart attacks, they survive strokes, but they live in
Not
diminished
no longer this. Yes,
capacity,
yes.
right? And I was power of attorney for this lady from Grenada, wonderful lady, had one of the best minds I've ever encountered. I just hung on whatever she said, and I would think about what she said for days, you know, trying to understand it, and before I'd have further discussion with it. And she had the best diet of anybody I know because she invented a new field in the area of nutrition. She was a professor at university professor, and and yet, despite the fact that she did all of these things to stay healthy, she had dementia at the end of her life.
Oh,
And it was really sad to see that. So it can happen to us. So the second thing is some people don't like the fact, don't want to, what if I pay money into this all these years
yeah.
and
It
I
doesn't
never
get
use
any
it?
better. Yeah.
Well, that's like car insurance or homeowners insurance.
Hmm.
It's generally the least expensive way to buy it, but we can also get it so that there's a death benefit or annuity benefit, so that if you never need the care, you can get
So,
covered
yeah.
in that regard. And then the third aspect of that is, why don't I just invest the money and self-insure
Self-insure.
with the gains I get? Well, we can show you, as you mentioned, I'm an actuary. I can show you spreadsheets that, pretty much, you know, your investment's not going to be able to catch up. And there's several reasons why. First of all, it's like anything else. What if you need it quickly and your investments haven't had a time to grow? But the other reason is that if you're going to self-insure your risk,
Mm.
you have to be prepared for a long need. You have to be prepared for an unusually expensive and long need. You may have to be prepared for that both you and your spouse have a long need because, you've got a very small sample that you're insuring, just yourself and your
Hmm.
spouse. The insurance companies don't have to plan for you to have a long need because the insurance companies cover hundreds of
Yeah.
thousands of people, and
Yeah.
they know there's going to be a few that have a tremendously
Early.
long
Yeah.
need,
Yep.
but they know most people aren't. So they can take the money for the people who never need care or just need a little care and
Yep.
give that to people who need a
Hmm.
lot of care. For
Yep.
that reason, the insurance companies can give you coverage that would cover, a catastrophe, and they can give it to you for dimes on the dollar. And so, so that makes it a good, that makes it a better deal. But even though that's a better deal, some people might not want it. And a lot of people and a lot of advisors think of it this way, which makes a lot of sense. At any point in your life, you and your financial advisor are trying to maximize your assets.
Hmm.
And one way to maximize your assets is to minimize your expenses.
Hmm.
An insurance premium is obviously an expense.
Yes.
So people think, well, if I can self-insure, I can avoid that expense, and that's a good idea. And that makes a lot of sense. So what I ask people then is I say, okay, not only does that make sense, but I bet you're thinking that if you never need care,
Mm.
you'd have all this money you didn't spend on insurance premiums, you could spend it on something else.
Something else.
So I ask people, what would you spend? Name three things that you might spend that money on. If you never need care and you save some money by not paying insurance, what would you spend it on? And what do you think your clients would say?
Well, I'm pretty sure there are a lot of things they want to spend it on. Maybe travel. If it's number one, I work so freaking hard now. I want to go travel and see all those places I've never seen before. Right? I'll give it to my kids, college education. No? What is it?
Exactly.
So they remember
You
me.
are exactly right. You are exactly right. The number one answer is travel. Absolutely. They're going to go on a cruise. All right. So so then I said, okay, that's a good idea. But when are you going to know that you never needed care so you can spend that money on the
You never
cruise?
know. And you
And,
don't know how many
right?
years
And
too, okay? So
and people, yeah, I get the reaction I get is sometimes I get what I call the Fred Flintstone reaction. If you ever watched
okay,
Fred
don't ask me
Flintstone,
this question. I
sometimes
don't want to
his
know.
face would turn to granite
I
and then
know.
it
I
would
don't want to
fall apart and
know.
people's jaws drop because yeah, their jaws drop and they say, I never thought about that, right? So the answer is that you may never know when you needed care. Your kids are going to know, but whether you
And
needed
they
care,
look,
but you may never know.
yeah.
And so you can't if you're tying that money up and you're not able to spend it on yourself. So look at it this way. Let's say you've got some money that you want to leave to your kids, okay?
Mm,
The Pick some arbitrary amount. The first $250,000
mhm,
is the most important $250,000.
mhm, mhm,
That's going to let your child buy a house.
mhm,
The second $250,000 is a little less important. Maybe that lets another child have buy the house, but maybe that
mhm.
pays for your grandchildren's college
College
education.
education.
The third $250,000 is a little less important, and as you
And then,
go on,
yeah,
each
right.
$250,000 is a little less important. If one of your listeners doesn't quite agree with that, I suggest they talk to their partner because usually at least one of the partners will get
We'll
it, and they will,
agree.
in my
I think
experience,
so.
they'll explain, the
I
marginal
think so.
utility of money to the
I
other,
think
right?
so. Yeah.
So so it's that first 250 that's most important, then the next second 250, etc. Well, the way long-term care insurance works
Mm,
is long-term care insurance
all the way to the
scrapes
top.
away some of the last 250, the least important 250, in order to protect the first, second,
Third.
third, and
Yes.
fourth
Yes.
$250,000.
Hmm.
So that's why, people, when I talk to them, people decide they don't want to self-insure. It's amazing, affluent people buy this a lot because they appreciate the value of transferring risk.
Risk to
And
somebody
and
else.
you talked about you were talking about a study, a case study. I had a conversation one time with a financial advisor in Georgia.
Hmm.
He said, Claude, would you mind if I tell you my family story? I said, no, go ahead. So he had four or five sisters. I don't remember whether he had five sisters or it was five siblings, including him. Let's
Hmm.
say he had four sisters and himself.
Hmm.
And when he got married, his mother would not come to visit him. And he tried so hard to get her to come to visit. And he could never convince her to come to visit. So finally, he calls one of his sisters and he says, "Why is mom mad at me? Do you know why mom's mad at me?" And she says, "Well, what are you talking about? She's not mad at you." And he explains that she won't come to visit. And the sister says, "Well, she won't come to visit me either." Right?
After a certain age,
So,
you
I
don't
mean,
want to
this is
travel.
going on for years and years. And the five siblings got together and they took turns with strategies. They discussed what they could do. They took turns with strategies. They did all of these things for years and years. They could not convince their mother to come
Travel.
and visit. And then some insurance agent visited her and persuaded her to buy a long-term care insurance policy.
Hmm.
And as soon as she had the long-term care insurance policy, he started hopping on airplanes and visiting her
So she
kids
wants to
all the
keep the
time.
money in
She went
case
on
she
a
gets to the
cruise.
hospital. Ah,
Exactly.
that's
The
what it
kids
is.
never figured out that
Ah,
she was holding on to that
she
money.
wants
She was
in
hoarding
case
her money
something
because
happens.
she was terrified of being being dependent on the kids, and she was
Mm-hmm.
protecting the kids. And he said, you know, she was 74 years old or something when she bought that long-term care insurance, and it cost us a lot. And if she never uses it, it's the best investment we had. But
Mm-hmm.
we could have had her buying that long-term care insurance
Early,
when
yeah.
she was 57, and we could, and our
Yes.
children could have grown up knowing their grandmother. And we blew
Yep.
it because we
Yep.
never figured out what was going
She should have said something though. Interesting. Interesting. I mean, now
well, but
after
you know,
hearing,
people don't, right?
yeah.
And this is a big issue for your younger clients. You know, for your younger clients, the issue today is not so much their potential need for care.
Mm-hmm.
If they want to address that, fine. The bigger issue for them is their elders' potential need for care, because their elders' potential need
Oh,
for
yeah. Yeah.
care
Yeah.
can mess up not only their elders' retirement plans, but it can mess up
Everyone.
your younger clients' retirement
Yes.
plans.
Everyone. Yes.
So,
The
you know,
money.
we can help them. It's a very difficult it's a very difficult issue to discuss within a family. We could discuss that at another time, but it's very difficult to discuss with a family. We have some materials you can send to people
Right,
who,
right,
if
right,
they
right.
ask for them, you know, help them gauge the conversation. But the best thing is to have an intermediary financial advisor like you convene the family
The
together,
cash
whether it's
flows
in Zoom or
together.
whatever,
So you
and
see.
you can manage the discussion better
Uh,
than the kids can. And having that discussion is critical for the kids and their parents' futures.
So so back to you. Okay, so like what's the best age? I know you said the earlier the sooner the better. So, when is a good time to think
Mhm.
about long-term care? What would be a good age? 50? Younger?
So the sooner the better. And of course, if you're very young, think about it for your relatives. And then absent that, I would say in your early 50s, because
Early
it's
50s.
in our 50s where some of us
Start
start to
taking
have
something.
adult onset diabetes and our
Yes.
height weight ratio
Start taking
changes
pills.
and we have surgery. So you want to buy it before those things occur.
Right, right, right. So early 50s. Interesting. There's something that you have to think about, even though you don't want to think about, because this is like if you want to manage your risk, the money that you have, I mean, you don't want to squander it away all like $10,000 a day in some type of nursing home. So you need to
Mhm.
take some action steps. Yeah, I think I learned quite a lot from you. This is great.
Well, our goal, you know, when our goal is that the people consider this carefully.
hmm
One time we, you know, ask whatever questions they have. We want to make sure they understand what they're doing and make sure they're
hmm
comfortable that they made a really sound choice for them. And then once they've done that, you know, they can put it in a safe deposit box. They can inform their children and their, you know,
Yeah.
advisors, their attorney,
Yep.
their CPA, all those people.
hmm
And then they don't have to worry about it anymore,
That's right.
right? And
Yeah.
that's
Put
really
it away.
wonderful. You know, do
Yeah.
it once, get it taken care of,
Yeah.
and
Oh, so, but you cannot
now you don't
prepay.
have to worry about it.
You have to pay every single month. Can you pay like a big installment, like, get it done within 5, 10, whatever years? You can do that.
You can, yes, you can. So you can get it paid in one installment if you want.
Mm-hmm.
Most people pay for it on a monthly or annual basis. It's usually more efficient to pay annually.
Mm-hmm.
You can pay for it automatically through your checking account.
Mm-hmm.
And one thing that the industry does that's really wonderful is that you can name an advisor or a child, more than one person, to be notified if you ever miss your premium payment.
I
Because, you
see.
know, under contract law, if you miss your premium payment, the insurance company can cancel the contract.
Right, right, right,
But
right.
with long-term care insurance, that's the last thing we want to have happen, because if you get dementia, one of the first things that happens is you
Right.
stop paying your bills.
Yes, you don't know
So
what's
what
going on.
happens is we have what's called third-party notification, and the insurance companies and regulators all agreed to, because
Mm-hmm.
you know, we don't want people to pay all these years and then not have coverage. That's a disaster.
Yeah.
So you name somebody to be a third party to be notified. The insurance company never notifies them about anything unless your premium has
They're
become
not
overdue.
true.
If it's at a point where they have the contractual right
Uh-huh.
to cancel your policy because of the third party notification, they don't have the right to cancel your policy. Otherwise, they could cancel your policy. But because of the third party notification, they have to contact that third party and give them 30 days to fix the situation.
Mhm.
That can be wonderful for the kids. Oh my God, I didn't know something's wrong with dad, right? I better
Mhm.
check on how
Mhm.
dad's
Mhm.
doing, right? Because why isn't he paying his bill, right?
Yeah.
So it's a early warning, and
Mhm.
it keeps the policy in force. So that's my favorite provision, and I always am urging people to name people,
Name.
and don't
Right.
name your
Yep.
spouse, name somebody else is better.
Somebody
And
else.
the insurance companies will check with you every 2 years. They'll ask you, is this still the right person? And is this still the right contact information?
Good. Good.
So
Good.
that's a great provision.
Yeah, that's a great. What about this? Like, if I own a company, can I get my company to pay for my long-term care? So I get company deductions too? Is it allowed?
Absolutely. So there's some really nice tax deductions. When an employer pays for the coverage, and the employer can be very selective about who they'll pay for. So
Hmm.
oftentimes we'll get company that'll pay for the lady who runs the company and also for her spouse or partner.
Yeah. Hmm.
And all of that can be very, very attractive
This
on a
is
tax
great.
basis.
Yeah.
Plus, I think a lot of your clients live in New York.
Hmm.
In New York, if if your adjusted gross income, not your gross income, your
Hmm.
adjusted gross
Hmm.
income, which is lower, right? If your adjusted gross income is less than $250,000,
Hmm.
the state of New York has a 20% tax credit up to 20% of $7,500 a year. So up to $1,500 for you, up to $1,500 for your spouse. So that's $3,000 a year of the premium is essentially paid by the
That's
state
nice.
of New York.
That's
So
really nice.
that's an extremely
That's
attractive,
20% credit. I get my
yeah, that's
company to
very
pay,
attractive.
and then I get another 20% credit. Yeah, let's do it.
Well, you get a 20% credit on what you pay. If your company pays, you're not going to
Company.
get a 20%
Okay,
credit
so
when
I
you didn't
pay.
pay anything.
Okay, I see. So company will get the tax deduction, but if I
Right,
personally pay, then I get the 20%. So it's kind of the same.
right,
No
correct.
reason why you take care of this. This
So
is
it's more attractive to put it through your business. But if you don't put it through your business, it having that tax
still
credit,
like get
New York's the
20%.
most favorable in
Yes,
any by far
this
of
is
any state.
great. Yeah, this is really great. I didn't know about it. I'm definitely going to tell people. This is good. I think I learned quite a lot. If there's are there anything else you want to share? No? I know you
Oh,
have some
just
videos and we
I
can.
think people are lucky to have a bright individual like you looking after their
Oh, no, a
interests.
bright individual like you because so knowledgeable. I mean, I've learned quite a lot. You make me think, maybe this is just like car insurance. I'm paying every single, of course, I don't want to get into trouble. So you're paying to buy insurance in case something bad happened. Hopefully you need it. When you need it, it's like 10 times, 100 times money back. So that's what it is. All right, wonderful. So thank you so
Right.
much for your time. I think this is a
Exactly.
fantastic podcast. I learned so much from this today. So if anybody has any questions, please reach out to us and we will definitely get back to you. And then I'll post like,
And,
additional
and
resources. Hmm? Claude? Yeah.
yeah, I was going to say,
We
yeah, you're
might
going to
have
post some
some.
resources. Good.
Yeah, we'll post it and free learning. Let's continue to learn. So thank you for joining us today. And our next podcast will be on the Connolly Law, the impact of buy-sell agreement. It's a big impact of business evaluation. So let's continue to learn.
Yeah.
Until next time, stay
Yeah.
inspired. Thank you very much.